The market is acting like the danger is over. The S&P 500 is pushing back toward record highs. The Nasdaq is stringing together one of those streaks that makes investors feel like the all clear has already been given. And if you only look at the index, you'd think Wall Street has already made up its mind, that the risk is behind us, that this rally is real, that the market has looked through the war headlines, through oil, through the shipping disruptions, through all of it, and decided none of it really matters. But zoom in a little closer, and the picture gets a whole lot weirder, because underneath this rally, the headlines still look messy. We're still seeing threats to global shipping lanes, oil risk that could roar back into inflation expectations real fast, and geopolitical noise that hasn't gone away. It's just getting ignored right now. And here's the thing that almost nobody is talking about. While most investors are still trying to figure out whether this move has gone too far, Congress is still in the market, actively buying. And based on what they've been filing, they are not buying randomly. There are real themes here. Quality businesses, beaten down valuations, earnings catalysts coming up, and a pattern that, whether you agree with it politically or not, has historically been worth paying attention to. Today, we're going through every single stock Congress has been buying recently. We're going to rank them, and I'm going to tell you honestly which ones look like the strongest setups and which ones you can probably pass on. Before we get into it, if you're serious about understanding where smart money is actually moving, hit that subscribe button. We put out serious research every single week, and this is exactly the kind of episode that'll change how you think about this market. Let's get into it. Let's set the stage first, because the context matters a lot for understanding why Congress is buying what they're buying. At the index level, the market looks calm, almost too calm. The S&P is climbing. The Nasdaq is climbing. Greed is starting to creep back in after a period of real fear. But underneath the surface, this rally is not as clean as the headline numbers suggest. Leadership has been narrow in places. Rotation has been violent. Some parts of the market are acting like we're in a clean breakout, while others still look like they're recovering from some serious damage. And the macro backdrop, still uncertain. Geopolitical risk hasn't gone anywhere. Inflation expectations can reprice quickly if oil moves. Shipping disruption is still a live issue. So the real question isn't just why is the market up? The real question is who is still buying at these levels? And when you look at congressional trading filings, you get a really interesting answer. Because the names they're buying aren't random. They're not chasing momentum into obvious highs. Several of these are beaten down names, quality businesses trading well below their historical valuations, with earnings catalysts sitting right around the corner. That is a very different signal than panic buying some hot trend. Year after year, members of Congress have managed to outperform the broader market. Not once, not by accident, again and again. And even inside Congress itself, people are openly admitting how bad this looks. Representative Tim Burchett from Tennessee, before the first House hearing on this in over 3 years, was pretty blunt about it. He basically said, "We all know what's going on, Congress knows what the hell is going on, and it needs to stop." That's somebody inside the system saying the quiet part out loud. Now, the Stock Act was supposed to clean all of this up. Passed back in 2012, it required trades over $1,000 to be disclosed within 45 days. Sounds reasonable, right? Except members have routinely blown right past that requirement. And the penalty for not disclosing? $200. Not $200,000, $200. And not a single lawmaker has ever been prosecuted for insider trading under this law. So the outrage stayed, the loopholes stayed, and the trading kept going. It got so popular that people started building products around it, ETFs, dashboards, entire strategies built around mirroring lawmakers' portfolios. There are apps now, sometimes called the Pelosi Tracker, where regular investors try to follow congressional trades in real time. That's the moment a political scandal becomes an investable signal. People stopped laughing at it and started trying to follow it. So that's the setup. Now let's look at exactly what Congress has been buying. And more importantly, which of these names actually make sense as investments on their own merits. First up, Intuit. And this one stood out right away because Congress didn't just buy it once. They kept buying it. Multiple filings, multiple buyers, repeated dip buying. And here's why that matters. Intuit wasn't being bought into strength. It was being bought after a serious reset. We're talking down around 41% year to date at the time of those purchases, trading near 52-week lows, a long way from all-time highs above $800. That's the kind of buying pattern that gets your attention, because buying weakness in a quality business is very different from chasing a hot name. Let's look at what actually justifies that buying. The business itself still looks solid. The last quarter was a beat on both earnings and revenue. And this isn't a one-quarter story. Over the last 8 quarters, Intuit has beaten on both earnings per share and revenue every single time, 8 for 8. That kind of execution consistency is genuinely rare. Looking ahead, they're expecting strong double-digit growth across the next several quarters. And the valuation? The forward earnings multiple has compressed massively relative to Intuit's own history. We're looking at around 16 times forward earnings, near the lowest it's ever been, compared to a 5-year average closer to 32. Here's the really important part. The underlying fundamentals have kept growing while the stock got punished. That disconnect, price deteriorating, business stable or improving, is exactly the setup value investors spend years waiting for. On a discounted cash flow basis, using a conservative growth rate of just 8%, well below their recent 30%, intrinsic value comes out around $598. Against where the stock is trading today, that's roughly a 34% margin of safety. Wall Street's consensus price target is around $583, implying about 48% upside over the next year. The Intuit thesis is pretty straightforward. Congress may be buying a high-quality business that got punished way too aggressively, with an earnings catalyst ahead that could help repair sentiment. The chart is still damaged. The market may need more than 1 quarter to fully re-rate this name. But on risk to reward, this looks like one of the better setups in the basket. Our verdict: a tier. Classic re-rating candidate. Quality business, strong execution, compressed valuation, and an earnings catalyst on deck. Now we get to NVIDIA. And this is where the signal gets loud. This isn't some niche trade. This isn't a couple of lawmakers taking a small position. Congress continues to buy NVIDIA at scale. We're talking large positions, dozens of politicians, repeated buying, including Nancy Pelosi, whose name has basically become synonymous with this whole phenomenon. The message with NVIDIA is different from Intuit. Intuit was a re-rating candidate. NVIDIA is a high-conviction consensus trade. And yeah, the obvious pushback isn't NVIDIA already the obvious winner? Doesn't everyone already know the AI story? Maybe. But here's what's interesting. NVIDIA is up around 8% year-to-date, recovering from a pullback, heading back toward all-time highs above 212. Wall Street maintains a strong buy rating, and earnings, coming in about 4 weeks, are expected to show triple-digit growth in earnings per share for the most recent quarter. When you zoom out to the last 10 years, NVIDIA has beaten earnings per share expectations every single quarter. They've only missed revenue once. On valuation, yes, it's a premium stock. But the lazy take that NVIDIA is always too expensive just doesn't hold up. Right now, it's trading around 25 times forward earnings against a 5-year historical average closer to 37. Still a premium multiple, but it's not peak euphoria territory. Our intrinsic value model puts NVIDIA at around $260, implying roughly a 24% margin of safety at current prices. Wall Street sees about 38% upside from here. And importantly, we used a 20% growth rate in that model. That's actually pretty conservative compared to the 59% they delivered in their most recent year. The Congress bet on NVIDIA is essentially a bet that one of the clearest dominant compounders in the market still has enough earnings momentum to justify further upside. And given the execution history, that's not an unreasonable bet at all. Our verdict: S tier, highest conviction, broadest congressional buying on the list, still premium, but probably less stretched than the market thinks. Real quick, every week I put out a free article covering seriously undervalued stocks and what's been happening in the market. You can sign up right below this video, totally free, and you'll get immediate access to our current capital allocation framework, including individual stock rankings and how we're sizing positions right now. Links down below, takes 30 seconds. All right, back to it. Waste management feels very different from the first 2 names. And that's actually important context. The congressional signal here is smaller, not weak, but smaller. Fewer politicians coming back to the same name. That alone makes it a different kind of bet. And the business itself is a different kind of bet. Steadier, more defensive, less exciting, less explosive, more predictable. The kind of name you park capital in, not the kind you load up on for a big re-rating move. The numbers reflect that. Up barely 2% year-to-date, trading around the midpoint of its 52-week range. The recent earnings history shows 2 misses in the last 4 quarters, a 50% track record, not a flawless execution story. Valuation is roughly in line with the 5-year average, which means it's reasonably priced, but not deeply discounted. Our model puts intrinsic value around $235. That's roughly a 5% margin of safety. Wall Street sees about 15% upside to around $257. Waste management is not a bad business. It's actually a really good business. But compared to names like Nvidia, Intuit, or MasterCard in this basket, the setup just feels less compelling right now. You're not getting a significant margin of safety. The earnings profile isn't as clean, and the upside isn't explosive. Congress is probably just treating this as a quality defensive position, somewhere to park capital with low volatility. That's a totally legitimate strategy. But if you're looking for the best risk to reward in this basket, this probably isn't it. Our verdict: B tier. Safe, steady, low excitement, solid business. Just not the most attractive setup of the group right now. MasterCard is one of the cleaner names on this entire list. The congressional signal is broad enough to matter, but not so crowded that it feels like everybody's just following the obvious trade. And the stock has pulled back enough to make the entry point genuinely interesting. Down around 9% year to date, trading near 52-week lows, though it's starting to bounce back. Strong buy from Wall Street. Earnings due in about 10 days. This is a company that compounds over time. 100% earnings beat rate over the last 4 quarters, double-digit growth expected over the next 4, and zooming out, 100% earnings per share beats over the last 2 years with only 1 revenue miss. Now here's what makes the valuation story compelling. MasterCard always carries this reputation of being permanently expensive, but right now it's trading at 26.6 times forward earnings, well below its 5-year average of 31.9. And the intrinsic value model is flagging undervaluation. For MasterCard, that is genuinely rare. Our model gives about a 23% margin of safety. Wall Street sees roughly 25% upside. This is not a deep value play. It's not a turnaround. It's a premium compounder available at a better than usual entry point. And that's often exactly the kind of setup that smart money looks for. Not when a stock is cheap, but when a great business is temporarily cheaper than it usually is. Our verdict? A tier. High-quality compounder. Better valuation than usual. Earnings ahead as a potential catalyst. Netflix is probably the most debatable name in this whole group. The congressional signal is real. And I want to be straight with you about that rather than just slotting it into a clean narrative. The congressional signal is real. There's enough buying, enough filings, enough participation that you can't just dismiss it. But the setup itself is messier. Up about 4% year to date. Though not that long ago, it was sitting at 52-week lows after all the noise around the potential Warner Brothers acquisition. It's bounced back, but it hasn't fully recovered. And the earnings history reflects that messiness. 50% track record over the last 4 quarters. Zoom out to 2 years. 50% on EPS, a bit better on revenue at 6 out of 8. Compare that to Nvidia's 10 for 10 or MasterCard's near-perfect execution. Netflix just isn't in the same tier when it comes to consistency. Valuation is interesting, though. 27 times forward earnings sounds expensive, and against its sector, it does carry a premium. But against Netflix's own 5-year average, that's actually a 27% discount. The market has repriced this name more harshly than history might justify. Our model shows roughly an 18% margin of safety. Wall Street expects about 19% upside. The bullish case on Netflix is that Congress may be buying a more controversial story, where the market has gotten too harsh on short-term wobbles. That's a plausible thesis, but it requires more faith in the narrative, more tolerance for inconsistency, and more willingness to sit with a messy picture for a while. Our verdict? B tier. Real signal, but a messier thesis. More debate, more uncertainty, and less clean execution than the stronger names in this basket. Microsoft may be the single most important name in this entire basket, and here's why. Just like Nvidia, the congressional signal here is massive. Tons of filings, tons of trades, tons of participants. That matters. Strong buy from Wall Street at 4.7 out of 5, and earnings coming in just 9 days. But unlike some names being bought at obvious highs, Microsoft is being bought after real weakness. Down 13% year to date. Recently bounced off 52-week lows that we saw not that long ago. All-time highs sitting up at 555. Strong buy from Wall Street at 4.7 out of 5, and earnings coming in just 9 days. This is one of the most durable franchises in the entire market, 100% earnings per share beats over the last 4 quarters. Double-digit EPS growth expected over the next 4. Over the last 2 years, 6 out of 8 EPS beats, 7 out of 8 on revenue. And the valuation, still significantly below its 5-year average, trading around 24 times forward earnings against a historical average of 31. The intrinsic value model signals undervaluation. Not as dramatic as a few weeks ago, but the gap is still there. For a business that almost always trades at a premium, that matters. Our model puts intrinsic value at around $481, roughly a 13% margin of safety, bought on weakness. Wall Street expects $572 over the next year. That's 37% upside. Microsoft is not a speculative bet. It's not a turnaround story. It's Congress buying one of the most durable businesses on the planet after the stock has already taken some real pain. Elite business, broad institutional relevance, strong execution, bought on weakness. That combination almost always works over a reasonable time horizon. Our verdict, S tier. Elite compounder bought after weakness. And that's about as credible as a congressional signal gets. Last one, Booking Holdings. And this one lands in an interesting middle ground. Congress has been buying here, but not at the same scale as Nvidia or Microsoft. The signal is present, it's just not as loud. The stock is down around 10% year to date, sitting somewhere in the middle of its 52-week range. Very close to a strong buy from Wall Street at 447. Wall Street sees about 21% upside to around 229. It's a good business. Earnings coming in about 8 days. And the track record is actually solid. 4 for 4 on EPS. Best possible record when you zoom out to the last 8 quarters. 8 out of 8 on both EPS and revenue. Valuation shows some compression, trading at 18 times forward earnings against a historical average just above 21. That gives us an 8% margin of safety in our model. Wall Street sees about 21% upside to around 229. It's a good business, a quality platform that compounds over time, and it's been bought by Congress at what looks like a reasonable, not screaming, discount to fair value. The read here is probably that Congress is treating Booking as a quality travel platform with decent upside rather than a high-conviction re-rating story. You could squeeze it into the A tier, but honestly, compared to the strongest names in this basket, the setup is solid rather than dramatic. Our verdict, B tier. Here's the final ranking. Good business, respectable upside, not the most compelling risk to reward of the group. Let's step back and look at the full picture, because when you lay all 7 names out together, the pattern gets really clear. Congress is not just buying one kind of stock, they're buying elite compounders, beaten down re-rating candidates, premium businesses at better entry points, and a few steadier names where the upside is lower, but the quality is still there. Here's the final ranking. S tier, Nvidia and Microsoft. These are the names where the congressional signal is loudest. Underlying business quality is elite, and the setup still makes sense even after everything the market already knows. Both are being bought after real weakness. Both have earnings catalysts ahead. Both have historically been near-perfect execution machines. If you're only going to pay attention to 2 names from this list, these are the 2. A tier, Intuit and MasterCard. Intuit because it looks like one of the better re-rating candidates on the list. Quality business, serious reset in price, real upside if sentiment improves. MasterCard because it's exactly the kind of premium compounder smart money likes to buy when it's not trading at peak enthusiasm. B tier, Booking Holdings, Netflix, and Waste Management. Not because they're bad businesses. They're not. But compared to the stronger names, the setup is either less explosive, less clean, or just less compelling on risk to reward. Waste Management is steadier but less exciting. Netflix is more controversial and less consistent, and Booking is solid, but not an obvious standout. And here's the real takeaway. Whether you agree with congressional trading or not, whether you think it should be banned or not, the reality is the money is still moving. And if you're willing to look closely, the pattern is usually a lot more interesting than the headline outrage. Because this isn't random buying. There are real themes here: quality businesses, compressed valuations, and earnings catalysts. And in a market that's looking comfortable again, maybe a little too comfortable, that may be one of the most useful signals out there right now. If you got value out of this breakdown, smash that like button. It genuinely helps more people find this content. And if you want the full spreadsheet models behind every stock we covered today, those are available through the link below, along with the free weekly newsletter. As always, do your own research, manage your own risk, and make decisions that actually make sense for your situation. We'll see you in the next one.